Welcome to Investor Copilot. I'm Viraj. Today I want to talk about a couple of key concepts. One being the frequency of your investments into the market, and second is the timing of your investments into the market. Now, both these concepts are particularly beneficial for younger investors, anyone below the age of 35 and relatively new to investments and starting out their journey in the investments into the markets can benefit from understanding these two concepts. So let's move along. First, I want to talk about dollar cost averaging. What is dollar cost averaging? Dollar cost averaging implies investing the same amount of money in a target security at regular intervals over a certain period of time, regardless of its price. Simple example of this would be, let's say you decide to invest in an ETF and you have exactly $12,000 with you. You make a decision to invest $1,000 each month into that ETF regardless of its price, and you make 12 equal deposits into that ETF. This would be a simple example of dollar cost averaging because you've averaged out your investment into that ETF. Let's look at this quote. The author of this one is unknown to me, at least. I have not found who wrote this, but it's a very subtle quote and a very good one and important to understand. It says time in the market is more important than timing the market. So let's look at what this means. Time in the market simply refers to the time span of your investments into any equity market. The longer the time span, the better is what this would mean. So the length of your time span into the market is more important than timing the market. Timing the market refers to catching a low point in the valuation of any security. Uh, it could be an ETF or stock that you're entering into the market, catching a relatively low point and avoiding an all-time high. That would be timing the market, timing it in a suitable way for you. So, what the gist of it is that the span or the lifespan of your investment in the market is more important than catching a low point for a particular security in the market. Now, the basis of this quote, there is some research that has been done by many asset management companies, many mutual fund providers, some brokerages, and I've done my own research and looked at a lot of sources and come to these particular 3 points that are important to understand in the context of our topic today. I'll read them out. So, over a period of 3 years in US stock markets, the following three statements hold true. Lump sum equity investment outperforms dollar cost averaging for equity 64% of the time. Second one is dollar cost averaging for equity outperforms fixed income investment 65% of the time. And third one is lump sum equity investments outperforms fixed income investment 67% of the time. So clearly from this information, we can see that lump sum investment, which refers to investing all of your available funds that you can spare for investment at the same time as early as possible into the market, will outperform any other mode of entry into the market for you. Uh, Lump sum in equity is what we are discussing. So lump sum investment in equity and entering the markets early, staying in the markets as long as possible will beat any other return, any other frequency of investment in terms of returns, is what this means. Obviously, we can see that lump sum equity investment is more favored than dollar cost averaging into equity, and definitely more favored than fixed income such as GIC or bonds. But this does not imply that you should put all your eggs in one basket and have your portfolio full of only equity investment. That is not the gist. You should always structure we have done videos on portfolio structuring before. You should look at structuring your portfolio, splitting your investments between equity and debt, and you should have cash products as well. So safe investment is important. but pay attention to these points, and this will give you a long-term and short-term benefit. Lump sum equity investment is something that will help you a lot. Have all your funds which are ready for investment and it's pair with you and in your savings, working for you in the market as soon as possible. That is the gist of it. So to reiterate these points, do not wait on the sidelines. Do not watch the market. Just roll by and invest as early as possible. Let your money go to work for you as soon as you can. Diversify your portfolio for sure. As we said, lump sum equity investment is not the only way to go. You should diversify and look at a mixed bucket and be positive and optimistic about the market. We are expecting a bull run in 2024, at least for the first 3 quarters. Take advantage of it. Thank you very much.